Welcome to the deep dive. Today, we're really digging into the latest economic and market news.
That's right.
Our goal here, like always, is to cut through all the noise, pull out the key insights from, well, a whole bunch of recent analysis. We want to give you that shortcut to being genuinely informed. Perfect if you're prepping for a meeting or just need to catch up, or maybe you're just curious, like us.
Absolutely. And just to set the stage, the analysis we're drawing on covers the market review period from last Tuesday, July 8th, right through to today, Tuesday, July 15th, 2025.
Okay, so let's jump right in. To really get the pulse of things this week, we have to talk about the CPI report, the Consumer Price Index, probably the biggest release, wouldn't you say, given the impact?
Oh, definitely. Huge focus.
So the headline number, it was up 0.3%. That met expectations, but, and this is important, it's a pretty sharp jump from the 0.1% we saw the month before.
Right. Quite an acceleration month over month.
And year over year, that number hit 2.7%. That's actually the highest since, what, February?
Yeah, highest since February. And core CPI, the one that strips out food and energy.
All right, the core.
That was up 0.2%. A little bit better than people thought, actually. The prior was 0.1%. So slightly tamer on the core front.
Okay, so core slightly better, headline up sharply month on month.
Exactly. And what's really fascinating is seeing how this directly feeds into what the market thinks the Fed's going to do with interest rates. Those expectations shifted dramatically.
How so?
Well, after the CPI data, the probability, the market odds, of a rate cut in July, it just plummeted down to only 2.6%.
Wow, 2.6. Just last week it was.
It was 6.2% the week before, and back in June, it was way up at 23%.
That's a massive drop.
It is. And looking out further, by the end of the year, only about 19.7% of investors now expect more than 50 basis points. That's 0.5% in cuts.
Okay.
And that 19.7%, that's the lowest probability for that level of cutting since mid-February.
So the takeaway is pretty clear then.
Very clear. Investors are getting much less confident that the Fed is going to be, super dovish anytime soon. The higher for longer idea is really taking hold.
Right. And speaking of pressures on businesses, let's switch gears a bit. Let's talk about trade and tariffs. That's another big cloud of uncertainty, right?
Oh, absolutely.
Last Wednesday was that deadline for the tariff extension President Trump had given. And it sounds like, while there were a few new deals maybe mentioned, most of it just got kicked down the road to August 1st.
That's the gist of it, yeah. Pushed back. And President Trump made that comment, a letter means a deal.
Right, I saw that.
Which, for investors just looking for some clarity, some certainty, that kind of statement actually adds more uncertainty, doesn't it? It's a bit ambiguous.
Yeah, it really does.
Yeah.
Do you have an example of how this uncertainty is playing out?
Well, yeah, a really concrete one. President Trump announced that potential 50% tariff on copper.
50%?
Yeah.
Oh.
And what happened? The price of copper shot up over 10% almost immediately.
Just on the announcement?
Just on the announcement. And the market reaction, we saw copper imports just soar. Companies were rushing, trying to get their purchases in before any potential tariffs hit.
Trying to front run it.
Exactly. And if you connect this to the bigger picture, this copper example really shows, in real time, how policy uncertainty directly messes with commodity prices, with supply chains. Companies making maybe suboptimal decisions just to avoid a potential future cost.
Which could cause problems down the line, like gluts or shortages.
Could absolutely lead to that. It adds risk.
Okay, so keeping those pressures, inflation, Fed uncertainty, tariffs in mind, what should we be watching for next? What data is coming up?
Good question. There are a few key releases. So Wednesday, we get the PPI, the Producer Price Index. That's expected to be maybe a bit better than the CPI, but still worse than the prior month's PPI.
Okay, so producer prices. What else?
Thursday is a big one, retail sales. The expectation there is for a pretty decent recovery from the negative number we saw last month.
Ah, so a look at the consumer.
Exactly. And then Friday, we get another consumer read, the University of Michigan's Consumer Sentiment Index.
Got it. PPI, retail sales, consumer sentiment.
And really, those last two, retail sales and sentiment, they're going to be crucial. They'll give us a much clearer picture of the U.S. consumer. Are they still hanging in there, still spending, or are costs and all this uncertainty starting to bite?
Right. That's definitely what we need to keep an eye on. Okay, let's shift over to the stock market itself. How did U.S. stocks do over the past 6 trading days or so?
Well, overall, U.S. stocks were up. But it was definitely a mixed bag beneath the surface.
How so? What did well, what didn't?
So the big guys did well. Growth stocks did even better, up 1.0%. And the NASDAQ, heavy on tech and growth, climbed 1.3%.
Okay, so large cap growth, NASDAQ leading the way.
Right. But on the other side, you had small cap stocks actually down 0.4%, and value stocks lagged quite a bit, down 0.9%.
Interesting divergence. Small caps and value underperforming.
Very much so. And this feeds right into this ongoing debate in the market. There are people arguing pretty strongly that this dominance of large cap and growth we've seen for a while now, that it's just going to continue.
And what's their reasoning?
Well, a couple of things. One argument is that these larger companies are maybe less exposed to tariff hikes. And the other big one is AI. The idea that these large, especially tech-focused companies are best positioned to really capture the benefits of all the AI enthusiasm.
Right. The AI narrative is still huge, but our source material actually pushed back on that a bit, didn't it?
It did. It offered a clear counter perspective. The quote was, "We believe investors should maintain significant exposure to small cap and value stocks. So basically, don't count them out despite the recent underperformance."
Okay. Maintain exposure to small cap and value.
And this brings up those classic, maybe slightly dangerous phrases you hear in investing.
I think I know where you're going with this.
Yeah, it's different this time.
And the opposite.
It's not different this time. Both can get you into trouble if you rely on them too heavily.
So how does that apply here?
Well, think back. Remember the dot-com bubble, late 1990s?
Oh, yeah. Hard to forget.
A lot of people back then were making that exact "it's different this time" argument about growth and tech stocks, you know? New paradigm, old rules don't apply.
And then?
And then the NASDAQ crashed, lost 78% of its value in less than 3 years, just collapsed.
Ouch. 78%.
Yeah. So looking at today, with the dominance of certain sectors, the AI excitement, this history kind of forces you to ask, right? What lessons should we draw? Is it truly different now, or are there echoes we should be paying attention to?
That's a really powerful historical parallel to consider. You know, are the fundamentals supporting the current enthusiasm, or is it getting ahead of itself? And speaking of enthusiasm and just incredible market moves, Nvidia.
Ah, yes, Nvidia.
It hit this mind-blowing milestone. First stock ever to cross $4 trillion in market cap last week. And it didn't stop there, kept climbing this week, closed at another new high today.
It's just unprecedented, really.
And get this comparison. The entire S&P 500 index, all 500 stocks, back in 1980. Its total market cap was only $1.2 trillion.
Wow. So Nvidia today is worth more than 3 times the entire S&P 500 from 1980.
Exactly. It just puts the scale of these modern market giants into such stark perspective, doesn't it?
It really does. It makes you think about market concentration, efficiency, all sorts of things.
Okay, let's zoom out a bit. What about global markets beyond the U.S.?
Right. So developed market stocks, think Europe, Japan, they actually underperformed U.S. stocks, down about 0.5%, more than 5%. And a big reason for that was the strong U.S. dollar.
Dollar strength hurting overseas returns for U.S. investors.
Exactly. But interestingly, emerging market stocks did quite well. They were up 1.4%, actually outperforming the U.S. market over this period.
And quickly, what about the bond market? We touched on yields rising because of the Fed outlook.
Yeah, bonds sold off again, second week in a row, pretty much a direct reaction to that CPI report and the shrinking odds of Fed rate cuts.
So yields went up how much?
The benchmark 10-year Treasury yield, it rose 9.4 basis points over the period, closed at 4.49%.
Okay, 4.49% on the 10-year.
And that jump, that sell-off in bonds, it just underlines how sensitive that market is right now to inflation news and Fed expectations. Bond investors are clearly demanding more compensation for holding longer-term debt if they think rates are staying higher for longer.
So tying it all together, the inflation surprise, the Fed rethink, the tariff uncertainty, the mixed stock performance with that large growth versus small value split, Nvidia's crazy milestone, global divergence, rising bond yields. It all paints a pretty complex picture.
It really does. It shows how all these pieces are interconnected, doesn't it?